This is the future of finance.
This episode is brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore, Maryland. Hi, everyone. Welcome to the Future of Finance podcast. I'm George Dyer, and today we have Paul Herman on the show. Paul is the founder of HIP Investor, which stands for Human Impact and Profit, HIP, and which licenses impact investing ratings on stocks and bonds to asset owners, advisors, and asset managers. They also manage some of their own strategies and provide advisory services. And we talk about how HIP uses its tech-enabled platform to gather and analyze tons of data to create these ratings for literally hundreds of thousands of companies and securities. We also talk about some of their work helping cities to find innovative ways to finance their climate action plans. We talk about HIP's climate threat resilience analysis and some of their strategies for investing in climate solutions. Paul is a longtime leader in the space. He's incredibly prolific. He's also written 2 books. One is called The HIP Investor, and the other is The Global Handbook of Impact Investing. And he just seems to be everywhere. He's at conferences, putting out webinar series, doing all kinds of things to educate people about the benefits of sustainable and impact investing. So I hope you enjoy it. As always, please take a minute to like this episode, subscribe to our YouTube channel, and share it with your friends. And now here's Paul. Hey, Paul, how you doing? Great to see you. Welcome to the podcast.
Thanks, George. Great to be here. Thank you for bringing us together.
Absolutely. Always good to catch up. How's everything in France these days?
France is very civilized, so it's plenty to eat and, of course, drink. And just had a bike ride today, too.
Lovely. What a great place to be. And so cool that you can continue all of HIP's great work from there. And yeah, I'm always so impressed and sort of amazed by how much you all do and how much you cover. And I'm still not sure how you do it all, but excited to dive into some aspects of your more recent work. But just before we get started, maybe just give folks like an elevator pitch of what HIP Investor is and does.
Sure. Happy to. Hi, everybody. I'm Paul Herman. I'm based in Chicago and France. We at HIP stands for Human Impact and Profit. And so what we've been doing for 19 years now is essentially quantifying the real world with data and how things actually work, in cities and counties and hospitals, as well as in companies and things like real estate. We translate those into data and ratings that investors use to quantify the future risk and the future return potential of their portfolios. We manage money for investors, advisors, 401k plans, as well as family offices and foundations like the Sierra Club Foundation. And then we, by doing all of that work, we help and guide issuers on how they can engage investors, impact investors even more, and how to make more meaningful climate action.
Mm-hmm. Yeah, like I said, you kind of cover every aspect of the value chain, or a lot of them, anyways. And I've always been curious, like, how do you access all that data? I mean, I'm always amazed by how many issuers you cover, how many securities. And yeah, just how do you get that data? How do you manage it? Is it really tech enabled, or what's sort of the general process?
Yeah, it's obviously tech enabled. We don't employ 10,000 people to collect data. And so our data comes everywhere from companies themselves, from nonprofits like CDP, Carbon Disclosure Project, which also tracks water and forestry and plastics. It comes from government sources. The government tracks a lot of data, especially when they pay money to hospitals. So we, tracking health outcomes of hospitals. We're tracking the power mix of power plants, for example, as to whether it's cleaner or more dirty. And then there's just third-party sources that end up tracking data as well. So we hoover all that up into one system. We quality check it. We relativize it to some hurdles like science-based targets, for example, or even in health that related to environment. To some U.S. EPA levels are watered down from the actual science that might actually trigger a health issue, like in water, for example, what causes cancer or not. So we hold it to a high standard of how impact investors can get the highest impact and what that can translate into for society. And then we turn around and we license that, either data for people who want to make their own ratings, into ratings for people who just want to make a meaningful decision, and of course into investment strategies and investment portfolios.
And so I imagine you use that for your own investment strategies too, the products you put together.
Yeah, we run on HIP. So
and you've been doing this for a while, so I imagine, like, are you always adding new sources for that data as you find new and better ways to get more information?
We add along the way. It's really as we add more scope. So one of the recent scopes that we've added is in the past 6 years is climate data. And that climate data isn't just weather events, related to heat or cold or wind or water, but they're climate data like, what are the toxic sites that exist in your neighborhood? What are the waste management sites where all the garbage goes to get dumped, like in southern Florida, in Palm Beach County, or where are the nuclear power plants that might get flooded, like almost happened in Nebraska a few years back? Where are the coal ash ponds that there's another hurricane in North Carolina this week, so there's a risk of coal ash ponds overflowing into the water supply. And then resilience data. So what is the strength of buildings and farmland, and resilience planning in each of those areas? So the core data that we started 19 years ago, those 30 metrics tend to be pretty consistent over time because they're great indicators of return on investment. The proportion of companies reporting on them has gone up. So the data goes up when the transparency goes up, but the core metrics tend to be pretty reliable over time. And then there's metrics that not many people have these days around things like biodiversity. And so those are still things to come for new data to be tracked in the future.
Yeah, got it. Just on that evolution of the transparency and the amount of disclosure that, companies have been reporting this information. I mean, obviously that's gone up over the last decade. Is that continuing? Are you seeing some slowdown in that with sort of the political context, or
we have
continuing
not seen an official slowdown? So I think companies who are publishing data typically are doing it because they recognize the risks. And as all of us who are investors know, you read the prospectus. So the prospectus has pages of all the things that can go wrong. So that data, once published, usually isn't backsliding. Where we did see some gaps in data was during COVID. Some of the government required data of muni bond issuers was put on pause in order to deal with COVID. Those might be hospitals not reporting health outcomes, or those might be schools not reporting on grades for students. So it took sort of a pretty transformative event to interfere with the flow of data, but the ability to capture new data, like from satellite photos, and being able to interpret satellite photos into not only greenhouse gas emissions and who's pouring chemicals into the water, but also like how leaky are buildings. So in Europe, for example, scientists did a study of satellite energy leakage using satellites, and they found that buildings in Norway adhered to a plus 1.5 degrees Celsius world, and buildings in England with coal boilers that hadn't been replaced and limited insulation contributed to a world where there would be 3 degrees Celsius increase in climate effects. So there's some more and more tools are emerging where we can capture real world analytics just by observing through satellites and the future of some artificial intelligence tools, but as well as through publishing from internal or potentially private data.
Yeah, that's so encouraging to hear, because I feel like we hear a lot of bad news on climate, but yeah, we are getting more information. And I was going to ask about AI. I imagine, are you integrating more of that into your processes, and do you see a lot of potential there to make better use
We
of all this
are
data?
tinkering it with it. We see some firms, going full bore into it, but we're um I don't know if it's, based on how old I am of being, I'm always willing to be innovative, like voice recognition. I thought that was, very, that was, voice recognition was a tool that was originally built for people who had, didn't have full skills and faculties. And that ended up being like an everyday consumer product.
Right.
Um, Artificial intelligence, like we gave it an assignment a couple weeks back for a proposal on what are corporations doing in sustainable farming and sustainable agriculture. And
Mhm.
it hallucinated one company investing $100 million that there was no other validation for in any
Mhm.
source. So it's good for, I think, ideas. It's good for sort of getting kickstarted with a blank page of
Mhm.
what's the latest and what people are thinking. But there's no replacement for original thought, and there's no replacement for disciplined quality control on analytics, especially since AI doesn't do math very well on top of it. So
Mhm.
it's helpful as like an augmentation, but it's certainly not a replacement for anything meaningful that we can
Yeah.
do.
Gotcha. Nice. And I also want to, so we'll hop into some of your recent work, but I also want to highlight that you're also an author. You wrote the Global Handbook of Impact Investing. Was that a few years ago now?
Well, this is, I guess, okay, yeah, here we go. We can see it.
There it is.
Global Handbook of Impact Investing, published by Wiley. Yeah, so that came out in 2021. So we're at the 4-year anniversary for the Global Handbook of Impact Investing. Yeah, it's 1,300 pages from 50 authors around the world. And so it's, bigger. It's officially bigger than War and Peace, but of course, there's more than war in the book. And we also wrote the Hip Investor book back in 2010 that has a 15-year anniversary on this past Earth Day.
Right.
Which is, I know, we want this conversation to focus on no jargon. That's written with no jargon. You can read 250 pages of no jargon
Mm-hmm.
related to impact investing. So, yeah, we take pride in helping to share what we learn, dig deep with doing our own research and then sharing that so that more of us can take action. That's really important to vote with your time, vote with your money, and of course, vote with your votes in the voting booth.
Yeah, absolutely. I'm just curious, what sort of like changed the most, you think, between those two books?
I mean, I think what's changed is the depth and breadth of what certainly of analysis. So, like full supply chain analytics of companies like IKEA and what their impacts are in the world is like that's one section. Place-based investing of how to build different forms of capital to improve places. That's another section. All the different ways that retirement investing is changing around the world, from Australia to Europe to the US, and how impact is being integrated globally, as well as, impact measurement and everything from microfinance to gender lens investing to equity investing. Everything's just gotten more and more, in a good way, more and more granular, more and more specific, and really continuing to reinforce what for some people is a revelation, like positive impact usually connotes positive return on investment. It's either more efficient investing, it's lower risk investing. Obviously, investing in people usually isn't just the cost might be the compensation you pay them, but the value can be whole new products, whole new intellectual property, whole new lines of business. And so that still is underappreciated today, is the positive return on investment of something like Great Places to Work, which is one of our investment strategies that has double-digit returns over 12 years. So,
Wow.
so it's just continuing to reinforce those same basic principles, like impact investing generally is positive return on investment, uh, and it's getting over some of those hurdles, like, oh, you're a tree hugger, or oh, you don't believe in cash flows. No,
Right.
it works. It's solid. So yeah, so more depth and more breadth and more global across all asset classes.
Yeah. Yeah. It's interesting how much has changed, as you say, in the details. And then, yeah, how some of those basic principles still haven't changed, where the misperceptions are there around financial performance. But it's great to have that track record. And, the data you all collect is really helpful in making that case and showing it.
Yeah, 19 years of data, 19
Yeah.
years of rating, 16 years of financial track record. We now have 8 years of issuer case studies of issuers trying new forms of financing and funding to fund their climate action. So yeah, there's no lack of positive case studies, but there's still a lack in some people's mind of, does this make sense or not?
Yeah, absolutely. Well, we're getting there. We're making progress. Let's jump into some of like the more recent activities or projects you all have been involved with, and starting with the municipal climate action financing, which I think is very new, right? But tell us a little bit about that, just sort of the general premise of helping cities.
Yeah, it's new in that we've been, it's going to sound not new that we've been working on it for 9 years, but it's new in that it's not really being applied as intensely as it could. So cities and counties and municipal bond issuers generally either raise money through taxes, raise money through fees, issue municipal bonds, and that's how you pay for the cost of operating government or municipality. But in climate action, hundreds of cities have made climate action plans that are at least not fully funded or may not be funded at all. So what we've been doing over the past 9 years with originally the Urban Sustainability Directors Network and cities like City of Palo Alto and City of Fremont, California, as well as Ithaca, New York, and Fort Lauderdale, Florida, Columbia, Missouri, Bend, Oregon, is taking the climate action plan. Well, first saying, what are all the different types of funding that governments aren't using that they could use? So that means obviously grants they're familiar with, and usually federal grants because there's a large amount of money. But grants also include corporate grants. So corporate foundations actually fund climate action, for example. Community foundation grants, either as a community or individuals using it as a pass-through. And then foundations, traditional foundations are doing that. So that's a deeper well that there's usually not enough skills or capacity. And I know one of our topics is, how can students and people new to the industry help? That's one, helping navigate grants for a municipal entity is a needed skill. Then there's a second category of loans. So most cities know loans through muni bonds, but you can also have private credit. And some of those, whether they be solar panels on a roof or electric vehicle recharging, as well as energy efficiency, either in buildings the city controls or in using the buying power of the city or the region on behalf of other buyers in that community, like the employers. That's an underutilized resource, private credit for funding city activities and climate action. Then you may even have private equity or venture capital for some pretty narrow uses where there can be ongoing sustainable business. And then public-private partnerships, or if you think of multiple sectors, multi-sector partnerships, where so the Apple headquarters, when it was built, uses a lot of water in the day-to-day operations. So they essentially created partnerships with different cities around Silicon Valley in order to not only make it water efficient inside the new Apple headquarters, but then to source water, fresh water as well as gray water that could be used. So there's a wide variety of capital types that could used. And this is about to take on extreme importance now that the current federal government administration is cutting back federal funding. And so 10%, 20%, 30% or more of city funding, county funding, school funding, hospital funding, water utility funding could be a major drawback that then capital markets can and impact investors can rush into.
And so do you go in and advise the cities on these various sources of alternate?
Yes, and the early work was building this catalog of what's possible. And in my work over the years, people always say, let's do something innovative, but show me where it's done at least one time before.
Right.
So we built this catalog of 100 plus case studies using 40 different financing vehicles. So the work in the past few years has been applying that to city of San Luis Obispo, or working with Columbia, Missouri, where the head of economic development, who deals with all the employers, has now become the mayor, for example. And cities in California, like Livermore, California, to take their climate action plan and then to say, here are ways you could fund climate action that aren't just a budget line item or a muni bond, but actually could be new types of grants, new types of loans, possible venture equity, possible public-private partnerships. And so that plan exists, and now the work is connecting the dots from actual investors to actual climate action.
Yeah, gotcha. Well, it's fascinating for me because my previous work at Second Nature with the president's climate commitment, where colleges were developing these climate action plans, a critical step very quickly became, campuses aren't an island unto themselves. They're part of communities. And so how do you work with the cities or the municipalities to help them create climate action plans to move the whole kind of community sector area towards carbon neutrality? So, that financing piece is a big question for how colleges and universities deliver on their climate action plans too. So it's exciting to
that
see.
principle that you described of you're an anchor in the community, I think is an underutilized lever to bring people together to act in a greater group, to whether it be a bigger aggregated purchasing group or a shared vision that we all act upon, that different people can contribute to. In most, whether it be a college community or a city community, there are employers, some of whom have headquarters there, but others of whom have franchises there, a Costco franchise, a Walmart franchise, a grocery store franchise. And they have pre-existing sustainability and climate goals that they need to hit. And so doing that in concert with the academic community or with the local city, county, region, again, is an under-tapped approach to actually make forward progress.
Yeah. Well, it's exciting. And tell us a little bit more about just like the private credit aspect of that, because the municipal bonds is sort of like the traditional way, but if the debt ratio gets too high, their balance sheets aren't looking good. Private credit is an alternative to that. If they can help them expand their.
It can be. It can be. And so, muni bonds are usually issued in the 30-year range, some 40 or 50, some 20 or 10. And private credit operates like in the 3-year, 5-year, 10-year range. And those are usually attached to things that have a more immediate payback. I'm sure you've discussed in your conversations here, like power purchasing agreements. And so that you set up a power purchasing agreement over a period of time to essentially average the cost of delivery over that time, and you collect revenue related to that. Same thing for energy savings in buildings from insulation. So companies like Schneider Electric or Asea Brown Boveri might come in to do essentially energy analysis and then set up a contract over time to do that. Those companies are using their own balance sheets to come in and use their capital. They might actually be using private credit or corporate bonds to do it. But cities could isolate that to specific projects and repeatable projects to do something similar. So once you understand the cash flows of what's flowing here and what the value, in some cases it's cost reduction that you can fund the paying the interest for that loan out of, or sometimes there's actual like fees that you collect, just like a toll road, where you can fund it out of the tolls that you collect. So there's a wide variety of innovation still to come, and to apply private credit to help advance energy efficiency, water efficiency, greenhouse gas pollution reduction. That has a positive health impact. When you reduce pollution, you improve health outcomes. So the cities don't yet have the experience in doing this. And in some cases, they don't have the skills internally to do it. And then one of the other barriers sometimes is the leaders of these programs, which might be the sustainability people, don't have enough of a working relationship with the people in finance.
Right. That's what I was going to ask too. Like there are private credit managers that maybe have a sustainability lens or an impact lens that might be excited about this kind of thing. The cities might not know about them or have those relationships. Do you help kind of matchmake and connect people around that?
We do. We help facilitate introductions so that they can get to know each other and knowing what they do. So like Climate First Bank, is scaling up, headquartered in Florida nationally to want to fund more climate action across the country. So those deposits, which are paying, they're paying customers 4% for their money if you want a high yield checking or savings account or money market account. And then they're reloaning that money out and collecting 7, 8, 9% interest or, whatever the risk adjusted interest rate is. And so those connections of, hey, did you know this person exists? So it's like supply demand connection. So it's really exciting to get those sparked, and then you got to like shepherd it through because it's not a typical way for cities to do business. So
right.
It takes you got to act your way into the future.
Yeah, well, it's funny. I mean, it's great work you're doing because, like you said, it's innovative and innovative finance, and this type of innovation is needed to create these solutions. But like you said, everyone wants to be innovative, but no one wants to be first usually. So hopefully, as you build more of those case studies, it'll build momentum, and we'll see that.
Yeah, we have 100 case studies. So there's at least 100 cases of this has been done once. And so you can use that as are we the first ones to do it? No, you might be the second ones to do it or the third ones to do it, but it's been done before.
Yeah.
It helps break down that risk aversion that sometimes people run into.
Are any of those case studies publicly available, or is that what you use when you go in and work with clients?
Yeah. If you go to hipinvestor.com/municipality, you can see examples and case studies and some of the examples of the funding and finance vehicles.
Yeah, fantastic. This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. The Intentional Endowments Network's 2025 annual forum will take place on October 27th and 28th at Goucher College in Baltimore. This forum will convene 100 to 150 endowment, foundation, and sustainable investing industry leaders to discuss how to maintain intentional investing momentum at your institution, covering topics including system-level investing, the fiduciary duty case for sustainable investing, strong democracies and political risk, climate risk and opportunity, responsible technology and artificial intelligence, inequality as an investment risk, and taking an expansive approach to talent. The program will be designed for endowment and foundation trustees, chief investment officers, and investment teams, as well as practitioners from investment consulting, outsourced CIO, and asset management firms. IEN events are intentionally designed to be highly interactive with plenty of time dedicated to dialogue at roundtables and networking, in addition to excellent presentations from experts and peer institutions. Go to intentionalendowments.org and click on Annual Forum to learn more. All right, let's shift gears now a little bit. You talked a bit about some of these waste sites and, landfills, toxic sites, coal ash ponds, and the interplay and the intersection with climate impacts as you have big storms that can exacerbate that, create health risks, and the like. So talk a little bit about how that work plays out and how you collect that data and how it translates into meaningful information for investors.
Yeah, happy to, George. When you mention climate, most
Mhm.
people think about the weather, or they think
Mhm.
about extreme weather. And there's 16 types of weather events that we track, from hurricanes to flooding to extreme heat.
Mhm.
Um, and so they all fall into four categories, like hot, cold, wind, and water. Those are the, big four categories.
Right.
But whenever those things happen, people in California may know when there's extreme heat, there's a risk of the power lines sparking fires. But there's also risks of flooding, overwhelming sewage systems. And so those
Mm.
sewage systems or waste sites where the garbage goes that is not recycled, and in some cases they, try and burn, or they're capturing the methane out of, those are active waste sites, but there's also nuclear power plants like in Nebraska, or if you remember the tsunami in Japan a decade
Mm-hmm.
ago, that they've flooded something that should not be flooded. um, and then you have all these leftover toxic sites of gas stations and chemical plant expulsions
Mhm.
and other aggregations. And there's 533,000 toxic sites in the US. Now there's 50 states. So that means there's an average of 10,000 toxic sites in each state.
Wow.
Or there's 3,000 US counties. So that means that there's an average of 150 toxic sites in each county of the United States on average. So, your real results will be different.
Yeah.
And so when these extreme weather events of hot, cold, wind, or water trigger an event with a toxic site, all of a sudden your risk has been multiplied. So we usually call them toxic site multipliers.
Mm.
And that is something that is not really tracked. And so that's something that we do that we're not aware of anyone else doing. And we have the latitude, longitude, addresses, GPS coordinates of those. So if you have anything from a manufacturing plant to a retail store, we applied this to Apple's retail stores of, the 230 retail stores they have around the US. So that amplifies the risk to those stores remaining open
Mm-hmm.
after an event. Um, and so that's getting people to understand, like, hey, first of all, this exists.
Mm-hmm.
You can put it on a map. And then you can start to assess the risk of, oh, this might negatively impact us as well as the community. So that's sort of the one of the three legs of the climate threat resilience analytics that we do. So in addition to the weather and the toxic sites, we also look at the resilience. And again, there's people talk about resilience, but how do you measure resilience? And
Mhm.
so things like farmland are less resilient than forest. So the trees absorb winds, the trees can even absorb water sometimes. But for those of you who are aware, in the Midwest over this summer, there was another dust storm. The dust storms hadn't happened in the past 100 years. There's some sandstorms in Arizona that have happened. So that propagation of farmland means that a dust storm may again connote less resilience to then shut down highways or cause accidents or get in the ventilation systems of houses. How old the building structure is. So I know you spent a lot of time in Boston, so the buildings are older there, maybe less insulated. In the best case, they're brick, but sometimes they're wood. And so that building envelope is less resilient in some cases, or less energy efficient than in other places where there's new construction, for example.
Mhm.
And then there's factors like community strength. So religious organizations frequently bring people together to help solve problems. So that's a form of resilience when something goes wrong. And then there's actual planning. And at the highest level of the 50 states in the US, luckily 48 of them have a hazard plan and a climate plan, but
Mhm.
two of them don't, Wyoming and South Dakota. So there's more risk in those states of Wyoming and South Dakota than there are in others, because there's just a lack of planning or refusal to see the issue. So it's a really involved, climate threat resilience analysis.
Yeah, it's really interesting, the layers there. And you've said that these resilience ratings don't correlate with like the traditional Moody's or traditional credit ratings. Yeah.
It's really fascinating. Again, when you run the data, we, love data and analyze it all the time.
Mhm.
So we took the all the bonds in the index, in the muni bond index, and we ran the Moody's credit rating from AAA to triple B on down against the HIP climate threat resilience ratings. And it turns out that the correlation between how we analyze climate and toxic sites and resilience had basically a 0% correlation to the credit ratings, to the Moody's credit ratings. And so you'd have AAA bonds like in Texas or Florida or Mississippi or Alabama that probably aren't AAA risks for the full duration of their bond. And so this is just a market inefficiency today that is not fully being realized by the ratings agencies. But for our clients who are, buying that information, they now have more information than they're actually getting from a Moody's or so. So that's really important if you have a muni bond portfolio as a high net worth investor or as a family office to know what is the risk inherent in my fixed income that I expect to keep paying and to have the principal returned.
Yeah, it serves as like another layer of risk analysis and just more data. What the traditional credit ratings, are they like not looking at climate risk at all in your view, or are they just doing it differently?
They are not looking at it enough. They are, the underwriters are writing in climate risk into the prospectuses, but the dirty little secret of many credit ratings is they're basically looking at like 2 to 3 years of financial cash flow. They're not looking at 30 years of risks. And so one of the biggest drivers is the collecting enough revenue in the city, not is that community resilient, such if there were a shock to it, could this community survive and continue to pay? So there's just a different like short-term cash flow mindset rather than a systemic risk. And so we're looking at systemic risk over the full time frame, and credit ratings don't always do that.
Yeah. Well, it's such an important time. I mean, for all investors at all levels, but the credit rating agencies in particular, as we're entering into this phase of increased climate impacts, and they're, like you said, they have these 30-year durations. It's going to be pretty important. So glad you're doing that work. And as you said, investors, high net worth individuals, families that might invest in munis can use this as an overlay. Who else are some of the kind of the target audiences for using this data? I mean, do you have just analysts at sell-side companies, firms using this?
The main customers for us, but of course, there's potentially more, are direct investors, family offices, family foundations that have, positions in the portfolio, advisors, either advisors to individuals or advisors to institutions that are building models for multiple clients and have, high net worth clients they're serving, fund managers who are trying to pick the right securities and understand what the risk profile is.
Yeah.
So, we have clients like Alliance Bernstein, for example, that, use our ratings. And then 401ks are another one, because that's long-term retirement money. And knowing what the risks are in the portfolio is something that young people are very conscious of, and how they're tilting towards more climate solutions. So, so a variety of customers. Always could be more types and bigger, but it's now we're in this wave of a little anti-sustainability, anti-ESG, anti-woke, but climate is not going to listen to politics. Climate is going to do what physics and biology and chemistry do. And so those who are paying attention are going to be have stronger portfolios, and those who are paying less attention, may encounter some surprises.
Yeah. And what an amazing asset to have that data as people are going to be needing it more and more. All right, let's shift one more time to, you just mentioned climate solutions. Talk about how HIP, thinks about investing in climate solutions, some of the products you have, and how you sort of define climate solutions in investing.
Yeah. So first of all, it's part of our, we've been doing this for 19 years. So we did it before the term ESG existed. So we've always had 5 pillars of impact that include health and wealth, earth, inequality, and trust. So earth has always been a factor for us. And the usual earth metrics have been around energy, water, waste, and then pollution, greenhouse gas emissions. So what we've done over time is not only put every investment through that analysis and filter and translate their actual data, their real data performance into leaders or laggards or insufficient. And so we've created several strategies that anchor around this. So one is called Climate Solutions. It's the newest one. That's really focusing on companies like Trane Technologies that makes heat pumps, or Schneider Electric, which consults around the world on how to be more efficient and climate resilient.
Yep.
Or say a Brown Boveri, which, connects the grids via transformers and the like. And so it's a lot of industrials, and it's global. It's companies with global revenue. Some of them are based in the U.S., some of them are based in Europe, some are based in Asia. They're all tradable in the U.S., so that's the focus of the portfolio is what's tradable. And some of those are ADRs, and some of those are, regular equities.
What's an ADR?
Is a American depository receipt. So a international company that doesn't yet have a U.S. stock ticker.
But you can still trade it in the
You can still trade it. So I say the Brown Boveri is technically an ADR. There's a second strategy called the science-based targets, and that actually tracks the 750 or so public equities around the world that have 100% by 2030 greenhouse gas reduction goal, or a 40% by 2050 greenhouse gas target goal. And in analyzing those 750 companies from their greenhouse gas reduction by year, you can create a glide path between their base year and the target year. And you can track their actual greenhouse gas, scope 1, scope 2, scope 3 emissions. And what we do is we track who's ahead and who's behind. And there's actually a third category of who's going the opposite direction. So the good news is there's quite a few companies who are methodically reducing, and they're ahead of their goal on average by double. So if they are trying to eliminate greenhouse gases in 20 years, they're on track to reduce them in 10. There's companies who have even more aggressive goals that are behind by half. So one interesting quirk is why these companies have even more aggressive goals and behind further is sort of an interesting observation.
Right.
And then there's a third group, which actually includes quite a few tech companies putting in data centers with artificial intelligence, pumping up energy. They have reduction goals, and they're adding
backwards. Yeah.
So this HIP strategy invests in those leaders who are ahead. And so those fundamentals are good. Those are good fundamentals. You're reducing the cost of energy, you're reducing the cost of water, you're reducing the pollution, you're reducing the future price risk as energy consumption may have higher prices in the future. So that's the second one. And then I mentioned Sierra Club Foundation at the beginning as one of our clients. So they allocate to sustainable real estate. So these are real estate investment trusts and real estate management companies that are more efficient with their building envelope and with their environmental performance, as well as, as an overall sustainable enterprise. So examples.
That's great. And is it a mix when you're working with clients like Sierra Club Foundation, for example? You've got your own strategies around this, and then you're also helping them allocate to external strategies in some of these areas?
In Sierra Club's instance, we're just a portfolio manager for them, and then they have a group that does what you're describing. But in other cases, we'll do both. We'll do, for family offices, family foundations, endowments, we'll both inform the overall, and then where they're okay with it, then allocate to us as well. So usually it's like be the strategy or be the manager, but sometimes it's both.
It's a mix, yeah. And talk a little bit more about that. You just mentioned some of the types of investors you have. Where are you seeing the most interest, or where have you seen the most interest in impact investing? Has it been more from the families and individuals or the institutional investors?
It is typically, in our 19 years of experience, there are people who are innovators and people who are risk avoiders, laggards. So the innovators act first and the laggards act last. In our experience, when there's one individual making a decision, like in a family office or a family foundation, that moves a lot faster than trying to persuade a group to do something, both from a group process as well as like, okay, we're going to take a vote. Are we unanimous? Do we have a consensus?
Right.
Who's fighting against it? Should we just wait one more year? So that number of decision makers is really sometimes an indicator of whether they're going to move faster or slower. And then sometimes there's, companies like with 401k plans, like this company Stoke, STOK, and they're run by young people and they're professionals who work inside this sustainability consulting, sustainability architecture firm. They're like, yeah, give us more fossil free portfolios. We want to allocate our retirement dollars to that.
Right. There's just no question.
So it's really, I'll talk to anybody once, but unless you want to take action, come back to me when you're ready to take action. And so, the data is there, the analytics is clear, the performance track records exist, the future risk is pretty, obvious if you want to see it. And if you don't want to see it, then,
it's hard to make you see it.
We need to focus. Yeah, we need to focus where people will take action. So we're happy to help educate. We have the books like you described, the Global Handbook of Impact Investing. We have this webinar series called ESGX during COVID that we've paused on now that has 83 episodes of how to learn about applying impact investing and climate action at esgx.org. So this exists if people want to do it. It's getting them over the hump of wanting to do it.
Yeah. Well, we feel that. I mean, that's what the network, the Intentional Endowments Network, is really designed to help those investment committees and boards reach that consensus and do that learning to get there. But like you said, it only takes one to kind of stop it, and it takes everybody getting on the same page to try something new and move these things forward. I mean, what have you found? Is it
powerful what you have with all the case studies that you pulled together, George, at the Intentional Endowments Network? And here's endowments who have done it. And here's academic endowments who have done it. And here's foundation endowments who have done it. So it's great to have, more than 10 years of that research that you've led.
Yeah, well, it's same like with your work, just having those examples for people to see that it's been done and that the financial performance is there just helps make it real. And is that like, what have you found to be most effective in those conversations? Is it, I find sometimes like the data is necessary but insufficient, it's like it has to be there, but it's the data alone doesn't always make the light bulbs go on and give people the confidence to move forward.
Right. Yeah. No data will definitely impede you. So that's amazing. Like, hey, you don't have any data. Okay, we've brought the data. Now what? And it's really a commitment. Like, I remember one investment committee where they said, tell us all the other people who have done it in our niche. And I'm like, you're the first. So would you like to be the first? And they said yes. But there was this, pause of, do we want to be the first? What will it take for us to be the first? What happens if it goes wrong?
Yeah.
So there's just some basic human nature to understand and to really even, when there's one decision maker and they believe, that's really easy. There's a group of moms across the U.S. that are working on pushing 529 college education plans to including more sustainable options or fossil-free options. And they're making progress because they're going to the meetings of the investment committees of the 529 plans. They're engaging and building relationships with the trustees. They're meeting with the institutional consultants, investment consultants to say, here are these examples that exist. And there's progress being made in California and Massachusetts and Oregon and other states. So that's super exciting that as somebody takes seriously their desire to serve the citizens of their state, that's super exciting.
Yeah. Well, it's so true. It's a lot of human nature involved, a lot of culture, a lot of mindset shifts that need to happen. And, it takes the leadership for some of those groups to go first. And then I think the other big piece is just people recognizing what you've been talking about this whole time, like the risks and how this applies to their fiduciary duties, that if they're not thinking about what the world is going to look like in terms of climate and inequality and health risks and, some of these real material risks to their investments over the next 10, 20, 30 years, that they're going to be missing a key element of their fiduciary duty.
there are big downside risks, and there are core fundamental needs that, there are products already today that serve these heat pumps and energy sensors and the like. And so it really just takes having a backbone to say, hey, we believe in this future where, the past is not like the future. All investment disclaimers say that. And when politics happen, you got to attack the insanity. You can't just let it go by like, oh yeah, climate change is a hoax. Or
Right.
hold up a snowball in the summer and say, see, that it doesn't really exist. And so those conversations are not helpful. And so they need to be taken on too, because if we don't stand up for it, then they'll just keep propagating, some of their nonsense. So deflecting the insanity is super helpful, and having a backbone and just leading by example. Most people, once they're in it, then they keep trying to improve it.
Right.
And so that's the thing, is just get one foot in. I think you and I have talked about this over 10 years. Like, okay, do 1%.
Yeah. Get started.
Do 10%. Or if
Mhm.
you're good, do 50%, have a 50-50 portfolio competing against each other. But do something, and then that will lead to lessons, and then that will lead to, more exploration potentially.
Yeah. Nice. Great. Well, Paul, we are going to jump into our final questions here, unless you've got anything key we missed that you want to share before we do.
Let's go for it.
Awesome. All right. Our quick takes first. We talked about you being based in France now. What's your favorite thing about France?
Well, one is it's civilized. There's no school shootings. Two, people are really respectful. Whenever you meet somebody, you say bonjour. You don't just like launch into something like you're in New York. And, when you live in a country that has more than one cheese a day that you can eat, that's pretty nice.
Awesome. A few things. It is a great country, and you're in a great part of it. How about a TV series, a movie you've watched recently that you liked?
There's two that come to mind. One is The Studio with Seth Rogen, because it shows humanity, good and bad humanity, and people who are trying to do something innovative. And sometimes, there's a lot of sparks that fly. Another one is Slow Horses, because I think that's Slow Horses. Both of these are on Apple, by the way. I think Slow Horses is getting the system to work for you is not always easy, but there are good people in a system. There are good people in a bad system that can still do good.
Nice. The Studio I've heard of, but I haven't checked either of them out. But what is Slow Horses? What's the basic premise?
Slow Horses is the all the spies in the UK spy world have been consolidated into this one group of not fast horses, but slow horses.
Oh, nice.
Or an episode, or episodes in their lives, but come together to be a force for good.
Nice. Awesome. And how about related to sustainable investing, a book, podcast, or resource that you'd recommend in addition to your books?
Yeah, I mean, in addition to the HIP Investor book or the Global Handbook for Impact Investing, both of which are published by Wiley, in addition to the esgx.org webinar series, like your Future of Finance series, I'd say Donut Economics is one that gives you a full systems view. That isn't just one lane, it's a multi-lane highway of all the things that we have to do as humans in a society in balance with nature. So I'd say Donut Economics by Kate Brewer.
Yeah, good one. It's fascinating. We've talked a lot about ecological economics, Herman Daly, other structures, the natural step framework, and I think Donut Economics is one that fits right into that. Another really interesting, helpful way of looking at new economic systems.
Yeah, and Bill Gates has one on climate change and what we can do for climate change and climate action. And he makes it, it's a pretty everyday language that he does. So I don't agree 100% with everything that he writes.
Right.
It's written like there's a point of view.
Yeah, nice. Awesome. And then when you're not working on all of this and collecting this data, doing these ratings, what might we find you doing outside of work?
Well, team sports is one: basketball, volleyball, pickleball. I might be cycling, through some vineyards, checking on the status of the grapes. Or I'll just be at the market thinking about what, fresh fruit or veg or, food to prepare for dinner.
Nice. Good living. Awesome. All right. Well, our core final two questions here. What's your vision for the future of finance?
I mean, my vision for the future of finance and for the future of the world is vote with your time, where you work and what you talk about every day. Vote with your money, not only how you spend, which a lot of people tend to be pretty conscious in their spending, but how you invest. including in your 401k. And I've taken this poll at sustainability conferences where 90% of the people say they spend sustainably, but only 10% of the people invest sustainably. So we should close that gap. And vote with your votes, from, school boards to city elections to state elections to federal elections, and protect our democracy because it needs protecting.
Yeah, awesome. And then finally, for young people interested in getting into this field, what kind of advice would you give them?
Yeah, this is a great question. And I'm going to give you my, take on it, which may be a little bit controversial with all the technical tools today. Read everything. I started reading Business Week for some reason at age 12, which is now Bloomberg Business Week. And I just learned all the different business wins and losses along the way. So build up a technical knowledge on some topics, not just, deep, but across. So I'd say read everything, which is very possible these days. Then analyze something quantitatively. And this means not ChatGPT. Build a spreadsheet and analyze something, do a correlation. Does that make sense? Is that intuitive? So analyze something. Quantitatively is helpful, but it could be qualitatively. And then for young people, write daily, meaningfully, on an insight you have. So LinkedIn gives you a free publication site or a blog or a vlog or however, but write something, because the goal of all of this, to read everything, analyze something, write daily, is be the magnet. Lead by doing. Have a point of view that people oh, that's interesting. Because then when you look for a job, they might go to your LinkedIn site if you have one. Hopefully you do. And now you have this whole catalog of content that might even be a book or a series, and people oh, that's super interesting.
This person's engaged
on content. Yeah, and they're taking action and they're thoughtful, and I may not agree with that, but that's an interesting way of looking at that. So I'd say be the magnet, lead by doing, and read a lot, analyze, and then write about it, because otherwise somebody's going to judge you on a 1-minute view of a social media or a 30-second view of your resume, or just judge you by looking at you instead of judging who you are and what you're for and how you think.
I love it. Great stuff. Well, Paul, thank you so much for doing this. It's always great to catch up. And thank you so much for all the work you and Hip Investor have been doing for so long. It's really been such a powerful contribution to the field. So I appreciate it.
Thank you, George. And the same for you. And delighted that we could team up over these 10 years in helping bring more intentional and impactful investing to investors of all types. And we need more of it. So thanks for all your leadership.
Absolutely. We'll talk soon.
All right. Sounds good.
Take care.
Thanks.
This episode has been brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.